I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi everyone, I'm Jason Balara and this is the Know Your Why podcast. Today I'm here with John Rickgarn. John, thanks for coming on the show today. How are you doing?
Not too bad. How are you doing, Jason?
I'm good. Again, thank you for coming on.
Thanks.
John, I'm going to let John kind of tell you his story, but he's actually got quite an interesting background of how he got started in real estate and kind of some really good, I think, sort of mindset type of topics to bring up. So if you would, why don't you tell us about yourself?
Sure. So I guess high level, I'm located here in Marshall, Minnesota, southwest corner of the state. I always throw out home of Schwann's ice cream and Red Baron pizza. That usually tends to get some people an idea of where I'm located, or at least know where they've heard of Marshall before. Yeah. My journey has kind of been a little bit more interesting, to say the least. So I have been a real estate investor since 2016, but if you will, I kind of had my awakening moment back in 2014. It's actually November of 2014. Surprisingly enough, I can kind of remember exactly where I was, on the couch with my laptop. It was at night and just was, kind of thinking, shall we say, kind of going over my life. My wife had just left a toxic work environment and we were down to one income. At the time, I was a full-time salesperson for an office equipment company. And I'd done, relatively well over the years, and just kind of started to think of, well, okay, we're down to one income. Gotta, sell more copiers, sell more equipment, maybe pick up a side hustle. Your mind just starts thinking of all these ways to accumulate money. And it just kind of had an awakening at that moment that I realized I was 31 years old. If I was to essentially relive my entire life, all those memories, that entire span of time, I would only be to 62 and still not at the arbitrary, retirement age of 65. And that would be from working 40, 50, 60 hours a week like I was accustomed to. So that was kind of a downer right there. I was thinking, okay, another 31 plus years of 40, 50, 60 hours a week. Not all that exciting. Okay. And then just kind of had another epiphany of, well, even if I, did all that and everything worked out fine, and I had a humongous retirement plan when I turned 62, 65, like we're supposed to, what's to say I'm even going to get there? And I say that because both my parents died of cancer by the time I was 16. Both of them were in their 50s. They did all the right things, go to school, get a degree, get a full-time job, max out IRA, 401k, retirement account, work, save diligently for decades after decades. And then you got to retire it someday. Well, they did all that, but then they passed away in their 50s. So I kind of look at it as they deferred so much of their life and so many years of their, active earning years, and they never got to enjoy it. So it was at that moment that I realized, okay, there has to be a better way than just, working for a paycheck. There has to be a way to start earning money now instead of just waiting till retirement. And that's when I really kind of did a deep dive into my investing journey through podcast, reading, networking, and starting the journey that I'm on today.
Yeah, well, I think I've interviewed a lot of guests that have had some sort of life event, tragedy, something like that struck them, right? And doesn't always strike you. I mean, it's probably hard to have these realizations at 16 when you've lost your parents, that what do I do financially about that? Kind of that's probably not the first thing you're thinking. But obviously it came back to to be a part of your mindset in terms of, well, what am I going to do from here? What is the point of putting life off until 65 if you might not make it there? So it's very kind of eye-opening when you come to that conclusion that obviously none of us are guaranteed, but maybe we'll get into that stuff too. But tell me a little bit about kind of your start into real estate and what you've been doing, kind of all of that journey.
Sure. So like I mentioned, this was late 2014 where I just kind of had a, shall we say, an awakening moment. And I figured, there has to be a better way. And so I started downloading podcasts and listening to them. At the time, like I said, I was in sales, so it wasn't uncommon to put 100 to 200 miles on the road in a day. So I would just, queue up a bunch of podcasts and listen to them while I was on my daily commute. And you start picking up little nuggets of real estate investing, depreciation, passive income, the tax benefits, so on and so forth. And just kind of, absorbed all that information, started to have my little checklist of, I want to buy my first property, want to make sure it hits the 1% rent to value ratio, newer construction, 1990s or newer, so on and so forth. And found that come summer of 2016, I ended up doing things a little reverse. I started with a fourplex and worked my way to single family homes, where a lot of people, I think, start with a single family home and work their way up to a multifamily.
Well, there's no wrong way really to, I think,
No.
to be to get into real estate. Just get in, do something. So
yeah,
that makes total sense. How did you, so actually let's talk a little bit about, I think it's something that maybe people skip over this. They the podcast, a lot of people listen to the podcast, but then you mentioned you developed your criteria. Right. So that's an important thing to decide what your investing strategy is going to be, right? Because there's so much. Really, when you start diving in, you start listening to those podcasts, like I'm sure you as well as me, it's just like you'll hear guest after guest after guest. They're talking about, someone's in multifamily, someone's in flipping houses, someone's doing notes, someone's doing self-storage. There's a million different ways.
Wholesaling or
right. There's just so many different ways, which is awesome because that means there's lots of variety and people can find different ways. But it's like when you listen to people that are, really successful in self-storage, and then you listen to someone that's really successful in like industrial whatever it is, and you're just like, oh yeah, I want to do that. Oh, I want to do that. I want to do that. That sounds great.
Shiny object syndrome, I think they call it.
Exactly. So you just kind of get in that mode of like, well, this all sounds amazing. So how did you, I think it's good for people starting out, like, how did you decide what was best for you, what your investing strategy was?
Sure. So, I had obviously listened to a lot of the podcasts, fix and flipping, which I'm not a handyman by any stretch of the imagination. So I know that wasn't my route. Wholesaling really didn't really fit with me. I just kind of looked at it where it was more transactional, where you have a large, transaction, you get paid, but you have to go find another transaction. And that was very much like what my current job was, where, sell a large piece of equipment, have the transaction, get your commission, you move on. And I think it was the passive income that I really liked, where, you're getting those monthly checks. And I wouldn't say you're not involved at all, but if you have a good structure in place, a good property management company in place, your team in place, it is very much hands off. So then you're also able to scale more, where if you're managing your own properties, there gets to be a point that there's only so many hours in a day and only so much that you yourself can do. But if you're outsourcing as many of those activities as you can, then you can, scale up more and then still get that passive income coming in.
Yeah, absolutely. And so you said you started with a fourplex, and then went to single family. Now, sometimes the single family, the sort of the single family or even the small multifamily might be harder to find someone to manage than like a large multifamily.
Right.
So are you self-managing, or were you able to go ahead and sort of outsource that?
No, I was able to outsource. Actually, from the beginning, when I first talked to my wife about this, going into real estate, her big thing was, I support you, I'm with you there, but we're going to have a property manager manage the property.
That's my
So
life.
even before I had picked a property, I'd already found a property management company, kind of knew what areas they covered, what they looked for. So we had the property manager lined up before we had the property. So kind of lined that up from the get go.
Yeah, no, and that's good. I mean, I think it's knowing who's going to manage the property, right?
Yep.
Whether, and especially if you're investing locally, if you're investing long distance, it's obvious that you're not going to be able to manage the property. But
Right.
if you're investing locally, then it's kind of like, well, am I doing it or am I hiring someone to do it? But you have to factor that into your budget, right? You have to say,
Right.
okay, well, there's going to be this much in terms of management fees. So and even if you're self-managing, in theory, you should essentially pay yourself something for that. Whether you
Right.
actually take the money, it should be sort of factored into your budget. So
Exactly.
so that's great. You had that, kind of ahead of time. How did you find that first fourplex?
Surprisingly, this was actually on the MLS, and like I mentioned, with my criteria of, newer construction, 1 to 4 units, could be managed by the property manager. My wife was even hesitant and figured, well, you're never going to find that. And lo and behold, the fourplex popped up on the MLS, and like I said, hit all my criteria. But I was thinking, well, I was thinking about starting with something smaller, but don't want to pass this up. So, we're talking about $300,000 property. And I thought back to a quote by Robert Kiyosaki of, don't say I can't afford it, ask how can I afford it? Because, $300,000 property, 25% down. I mean, that's not exactly pocket change for anyone.
Right.
So started to do a little bit of, put in the thinking cap, started thinking outside the box. And ironically, my financial advisor mentioned, you've had this Roth IRA since you've been 19. You can actually take out your contributions tax free and put that towards the down payment of the property. And at the time, I didn't think you could even do that. I just figured, okay, once it's in a retirement account, it's in jail pretty much. So ran the numbers and pulled out my contributions that I had put in for at the time it was a 12, 13 years worth, and that was the majority of our down payment right there.
Awesome. And it's actually a good, kind of story there, because I think that people don't realize that you can do things like that you can take some of your Roth IRA, or you can if you have a 401k or an IRA, you can take loans out of those and
Sure.
use them. If you have whole life insurance, you can use that. Talk about infinity banking and stuff. And so those are a little bit difficult concepts to, I think, understand sometimes, but the resources are available. So it's, I think there's a lot of people that think they don't have the money to invest in real estate, but really they just don't know that they have the money to invest.
Right. So, or even the resources, it can even be as simple as like you said, a loan from a 401k,
right.
HELOC, selling some, unused cars or anything that's in the garage collecting dust. So there's many different ways you can experiment with that.
You hear about people, and I'm not advocating for this, but there's lots of people that got their down payment by taking out of credit cards to get started in real estate,
which is their own if it works well.
Right. But as long as you have to run the numbers, right? So it's like, what's the risk reward ratio, and are you going to, if you take a loan out from your IRA and you're paying some sort of percentage back to it, but you're making twice that in terms of return of your investment, it's worth it. It makes sense. It's the same thing. If you take the money out on the credit card as if it's a short-term loan, it's probably no different than using a hard money loan for a fix and flip. It's just you're taking it from your set, right? You don't have to get anyone else involved. So the opportunities are there. So if you can find a good deal, you can find a way to kind of get into that good deal, I believe.
Oh yeah.
So you got the fourplex. Was it? I know you said you had sort of newer construction as your criteria. Did you have to do anything in terms of renovations, or was this sort of a turnkey type property?
I wouldn't call it quite turnkey. So interesting story behind the fourplex. The previous owners built it. They lived in one unit and then they rent out the other three. So it kind of paid their mortgage for them.
Mm-hmm.
So when we acquired it, it was actually vacant, which, plus or minus, okay, we can start fresh with tenants. But we decided to do a little bit of an upkeep, put a drain tile system in the basement just because we can get fairly heavy rains, and mixed with clay soil in Southwest Minnesota it can lead to water in basements. So we figured, let's put the money in now, and it's going to be a lot easier to do this when it's vacant than when it's occupied. And I think it was early August 2016 we had acquired it, and we had all the units filled by December of that year. So
Right. And do you still own it?
yep, still own it. So still cash flowing well. Knock on wood, didn't have a single vacancy all last year. It's been almost 2 years since we had a vacancy, and that only took about a month to fill.
Awesome. Awesome. And then since then, what have you sort of added to the portfolio? I know you said you went backwards, although
Yeah.
I think it's just investing is investing. I don't know that there's a
Yep.
correct
Yeah, it was
direction.
yeah, literally backwards. Then the next one was actually a duplex that kind of fell into our lap, and that's actually been our cash cow ever since. There was a owner of a duplex. They were calling our property management company for a reference on a tenant of, how long did they stay there? Were they a good tenant, et cetera, et cetera. And in the conversation, they were like, do you purchase properties as well, or do you just manage them? And Scott had taken the call and he said, well, we don't purchase them, but I think we might know someone that would be interested. So he called me up the next day, said, hey, there's an off market duplex in an area that we manage. Seller wants to sell it. Thought I'd, pass the lead on to you before it went on the MLS or anything. So that turned out to be really good for us. Up and down duplex, rent out the duplexes, but we also have a coin op laundry in place. And then we rent out the garages for storage for extra income as well. So
Awesome. Awesome. Yeah. Maximizing every inch of that property. It sounds like that's great.
yep, yeah, I got for profit streams from a duplex, so not too bad.
Yeah, that's awesome. And then how about from there? If you don't have to tell me each one specifically if you want, but just kind of where are you at today? What's your plan going forward in terms of your investing?
Sure. Well, since then it's got into a little bit to the short-term rentals, bought a second home, a condo in Arizona that we use as our second home when we're down there visiting, but we also rent it out, you know, obviously for short-term rentals. Then got into the actual turnkey space through Turnkey Providers in late 2019. Got two properties down in Alabama, one in Tennessee, Memphis, and just closed on another off-market duplex in Davenport, Iowa, late 2021. So right now it's just been I have a number of geographic markets that I look in and want to continue to grow in, but I'm always, cash flow first. I know a lot of people kind of get hung up on the appreciation, and I've even seen people buy a property and it's negative $100 a month, but that appreciation I'm going to make up for it. Like, no, it's got a cash flow from day one. If appreciation comes on top of that, that's just icing on the cake.
Yeah, no, I mean, and that goes back to your investment criteria, right? If your goal is to invest for strictly cash flow, then you got to make sure it's cash flowing, right? That has to be a part of it. I mean, some people invest because they want the losses. They've got some other investment, or they've got they make a lot of money at their W-2 job or something, and they're trying to sort of offset some of the taxes. So it really just depends on what you're shooting for. I guess in an ideal world, you're looking for cash flow and appreciation, but
sure,
in reality, you have to have a focus. And so, yeah, it makes a lot of sense. Kind of what you're going. Are you still working, or have you gone to sort of full-time investing?
I would kind of full-time investing. So I left my sales job back in late 2019 so I could focus more on investing. Since then, I've kind of picked up a few side hustles, but I'm a part-time realtor, also a full-time investor. I run a podcast, run a blog. I have a lot of side hustles to keep me busy.
Awesome. Awesome. No, that's great. I mean, and it's their, they might be side hustles, but they're all in the same space. If it's
Yeah.
all real estate related,
Yeah.
I'm sure
Well, and I
they're
would
all
say entrepreneurship. I mean, I am
right.
my boss. I mean, I can work a day if I want to. I can call my own hours. I can work as
Right.
little or as much as I want, and which is very fortunate now that I have a 4-month-old son. So in the cases
Awesome.
where he gets sick or daycare is closed, my schedule is very flexible where, okay, can't go to daycare. I can watch him for the day. Where if I was working like a traditional 9 to 5, even with the whole remote work nowadays, it still would be a little bit more difficult. So,
Yeah, absolutely. Well, I mean, congratulations on your son and
oh, thanks.
congratulations on achieving time freedom, right? I mean, I, that's what we're all really looking for is to be able to
Right.
make our own schedule and, spend time with family when we want to spend time with family or
Hmm.
when they need us. So that's fantastic. I guess we talked maybe a little bit about it before we started recording and stuff. Let's talk about the the traditional path to retirement and kind of what people are told is the right thing to do. And I think I get the impression that both of us are maybe of the mind that it's probably not the right thing to do, but maybe touch on what you talked about a little bit before in terms of the 401ks and all of that and the timing.
Yeah. And and I don't know if I would say, 401ks and IRAs are necessarily, bad. I think all of them can hold a place. I mean, I even still have a number of Roth IRAs and a self-directed 401k. I just haven't contributed anything to them for almost 6 years. I've just been reinvesting the earnings from day one.
Right.
I think for a lot of people is that they just kind of almost are, you know, maybe going have a tunnel vision where they, have their account with Fidelity or Vanguard or wherever the case may be. And okay, I have this in stocks, bonds, and mutual funds, and this will grow at whatever rate per year until I turn 65. And we can kind of go down the rabbit hole of average versus actual returns. But I think a lot of people just get so focused on that where a lot of people don't know that you can self-direct your retirement accounts. I mean, I myself have retirement accounts that are invested in cryptocurrency mining LLC and teak farm in Nicaragua and private lending and trust deeds and a number of other alternative investments that I don't think the average person even knows is out there. So it's not to say that the traditional retirement plans are bad per se, but I just think a lot of people don't know to how fully maximize them to their benefit.
Yeah, I totally agree. I mean, and when I say this stuff, I definitely was until maybe 2 years ago. I was in that camp of I'm just going to do what actually I was worse than that. I didn't plan anything for retirement for
Okay.
quite some time. I was just like, well, I like working. My plan is to not retire. That was
Mm.
really my retirement plan. But you know, there I think you sort of brought up a really good point in that the 401ks, the IRAs, that stuff's not bad,
Mm.
but it's worth investing a little bit of time and education into knowing what you're actually getting out of it. You touched on sort of the average returns versus what you're actually getting. And if, I maybe a year ago, I did a little exercise where I just pulled up because you're right. You can direct a lot of it yourself, although oftentimes, at least in my case, I can't self-direct my 401k for the job that I currently work at, right? That's
Right.
like
Yep.
you have a selection of funds, but basically you don't really have the ability to do that. But I looked at the returns and I looked at the fees, and between the fees and the mediocre returns I was getting, I'm making like 2 or 3% on my
Yep.
401k, which is that's at this point not even inflation. It's
Yeah,
not even
that's like
keeping
a
up with
third of inflation right now.
right, right. So it's just I think that, and people don't know that they don't know what's happening.
Hmm.
They're just sort of blindly putting the money in because that's what they're supposed to do. And I think like if you get an employer match, you should use that to your advantage
Yep.
because that's free money. So it's like,
Exactly.
it's just understanding all those little nuances, that how you can have a little more control and a little more, the word that's coming to mind is manipulation. I don't know that. I think it's just education of the possibilities with these things.
Yep.
And as you mentioned, you can take an IRA and make it a self-directed IRA and invest that in real estate or crypto or
Yep.
a teak farm, like you said. I mean, all that stuff is possible, and people don't know that. And
Right.
I mean,
And I'm not to really blame them, but I mean, if they go to their
right,
Fidelity or Schwab advisor and say, hey, I want to invest in a teak farm on my IRA, well, they're going to say, well, no, you can't do that. Well, they really mean, well, we as your custodian can't do
right,
that.
right.
And we want all those fees from you. So we're not going to advise you going to someone else that can self direct it. So
Yeah,
people just
yeah,
think, oh, this isn't possible.
yeah, right. And it's not always as easy to find those, self-directed options and the in the
Right.
alternative investments and stuff like that. It's not as easy as just, here's the money that comes out of my paycheck and someone else takes care of it.
Right.
That's an easy way to do it, but it's not financially, not the best way for you to do it. And
Mm-hmm.
I think you were lucky that you had a financial advisor that actually told you, hey, why don't you use this Roth IRA and take money out and put it, because that didn't help them,
Right.
right? That's
Yeah.
certainly, that doesn't get them anything. So it's another valuable point in the sense that, some financial advisors, as you mentioned, with these big companies and the brokerage accounts, they don't get anything if you invest in alternative investments other
Right.
than their funds. And so they're not going to that's not going to be a part of their company, so you're not going to be allowed to do it, or they're not going to tell you how. So when
Mm-hmm.
you I hear a lot of people say, oh, I have to talk to my financial advisor, and I sometimes cringe because I'm like, I feel like that person might only be telling you the options that benefit them. So
Right.
it's definitely something that I think a lot of us don't necessarily take the time to become educated in. And again,
Mm-hmm.
i'm not I'm not saying this like this was other people. Like, this was me for sure until relatively recently. So it's been a very eye-opening for me. So it's sort of a very cool thing to learn that there's all these other, possibilities that you can do, and you can put your money to work for you.
Right. Yeah, I think there was some stat that I don't remember exactly, but I think only like 5% of all retirement accounts are self-directed, but 25% of self-directed accounts have a balance of $1 million or more, which I think just speaks
Right.
to the power of self-direction versus
Right.
stocks, bonds, and mutual funds.
Right. If you're someone who takes the time to understand how this stuff works, you're
Mm-hmm.
probably going to do better with your money.
Right.
Really is. I
Exactly.
mean, it's probably the breakdown of that statistic. So yeah, it makes total sense. And the other thing that we kind of touched on earlier was the time, right? So
Mm-hmm.
we're talking about, these retirement accounts, and for all intents and purposes, you're not supposed to touch them till 65. And
Right.
so
Yep.
there's to me there's two sides to that. You talked about, well, what if you don't make it to 65? If you're putting off, essentially, I mean, you're not putting your life on hold, but you're saving that kind of time freedom until then,
Yep.
right? And that's, so that's, to me, that's one part of it. The other part of it is the way it's currently structured, and the way that people are taught is like that 4% rule, that you can take out 4% every year from your account because you're expected to live 25 years after you retire. But
Yep.
but okay, what if you don't? What
Yep.
if there's a stock market crash somewhere in those 25 years? Or
Yep.
what if you live 40 years after your retirement?
Yep. Yeah.
It's just like, it doesn't make sense. It's not a sound retirement strategy because you don't know. And I mean, you hope to live long and be healthy, right? But it's like the current strategy of retire at 65 and take 4% each year is, it's very flawed if you think about it,
Yeah.
in the sense that you're just kind of hoping that you pass before you run out of money. I don't
Yep.
really know
Exactly.
what the like it, and again, these are things that I'm just very
Yep.
recently sort of figuring out, that mentality doesn't make sense. So it's again, if you have a 401k, they're not bad things, but there's something that you have to understand what you're doing with it, and also look at things that you can do right now in your
Yep.
life as you have to obtain financial and time freedom
Mhm.
well before you turn 65.
Yeah. Well, and I think a lot of it just comes down to where, if you ask people of, well, why are you contributing to a retirement account? Oh, so I have a lot of money. Well, why? So that can provide me income in retirement. And I think a lot of it is like, okay, just work that backwards. If you're expecting, throw out a number, $5,000 a month come retirement, why not work today of creating passive income streams that will
Right.
start paying you $5,000 or even $500 a month now, and that continues on until retirement? Why delay that to a future date that isn't guaranteed for any of us?
Right. No, absolutely. It's you can set that in motion now
Mm-hmm.
and have, if the other thing with that, it's like, great, start that earlier. So that's one huge benefit to it. It's like,
Yep.
if you can set up investments so that you're getting your $5,000 a month when you're 30 or 40 instead of 65 or 70, obviously that's a much more desirable outcome. But the other thing is, if you if your plan is, again, you're going to have at 65 you're going to have some amount of money in that
Yep.
retirement account, and you're going to draw it down every year.
Mm-hmm.
If you've invested now in cash flowing assets, those cash flowing assets don't go away while you're getting your $5,000 a month.
Right.
They're going up in value, instead of
Yep.
the opposite thing that's happening on those retirement accounts when you start drawing from them. It's like, when you sell, the only way to get money from a stock is to sell it,
Yep.
right? But
Plus
you
pays a
can, if
dividend, I suppose, but
right, yeah, right, you can have it. But if you, even with dividends, you've got to take them out, right? You've got to do
yep.
something to withdraw. So it's kind of like, it's great if you can be in all these different asset classes, but the reality is that the ones that benefit you now are cash flowing assets, and most commonly that's going to be real estate.
Mm-hmm.
So it's something that, once I kind of figured this all out, it was just, I was like, now I want everyone to just like think about it, like really just think about it. It's a
Yep.
very full system that we have, because people talk about all the time, oh, we may not have such social security when we get to that age. I don't care about that. That's the least of our worries.
Yep.
Like, that's a thing that, if your goal is to live off that, there's we have to start the conversation even further back. But it's kind of like the that's the thing that people know about and hear about, but
Right.
don't think through the logic of like an actual 401k.
Right. Well, and the thing is, a lot of people kind of confuse the two because Social Security was initially put together as an insurance program back in the 30s. Life expectancy was 62. You couldn't withdraw till you're 65. So statistically, you're going to be dead before you could pull a paycheck. Well, now fast forward, 90 years? Now we're living into our 80s, but the retirement age has gone up a whopping 2 years. So it's kind of a little lopsided.
Right, right. Well, yeah, and I mean, we're living into our 80s. People who are, this is what I think this stuff is even more important for, like, people in their 20s right now. I mean, they're going to be living till they're 100. I mean, it's
Oh, yeah.
like, it's going to be like medical advancements, things like that, like general health wise, pandemic aside, people
Right.
people are continue, the average length of life is getting longer and longer. And so it's something that, that 4% rule in your retirement accounts just doesn't make sense anymore. It
Right.
doesn't fit
Well,
with the reality.
like you said, I was just reading, the median 401k balance, I think for people in their 60s was like 250,000. Well, you can do the math. If you're going to do 4% of that
Right,
and live off that for 40 years, and inflation's anywhere from 5 to 7%,
right,
I mean, you don't have to break out the calculator to realize the numbers aren't going to add up.
right, right. Yeah, that that's a great point, actually, in the sense that this whole 4% rule is predicated on the fact that you saved enough money that it's 25 times what you want to live off in a year.
Right.
So it's like, doesn't it just it none of it really makes a whole lot of sense. So it's kind of, but it's like, we just, that's what we're told to do. Nobody teaches us
Right.
otherwise. And so you kind of do what everybody else is doing. But that's why I think conversations like this are so important, is to kind of, get that word out there that there is a lot to it, that there's easy tweaks to make to this, that you can
Yep.
be comfortable much before you turn 65, and also not have to worry about running out of money at that point when you retire. So cool. Well, thanks for thanks for going on that tangent with me.
Yeah, no problem.
An important topic, but let's just switch gears, so I don't keep you all day talking about the broken retirement system. But
yeah, we could go on for hours, I suppose.
But let's just switch gears. I like to ask each guest 4 questions, so we'll kind of go to that portion of the show. The first one, John, is what is your why? And obviously it's based on the name of the podcast being Know Your Why, but what's your why? I have a feeling I know at least some of the answer to this, but what drives you towards success?
Sure. So my why, just kind of overarching, is to have time freedom and obviously family time, where I look at my parents. They unfortunately passed away at an early age. So I look at with my son now, that I want to be able to have the time freedom that as he grows older, whether it's a ball game, a play, or whatever the case may be, I can be there for him. I can, spend time with him and see those events that I can't make up for, not having to worry about, oh, gee, well, can I get time off from my job, or can I get this day off requested from my boss? I mean, that's my overarching why, to really live my life of how I want to live it and be there for my son and my family. And, having that passive income allows that time freedom for me to be able to do that.
Yeah. No, that's great. 100%. It's no secret to anyone who's ever listened to this or followed my social media that my why is my family as well. I've got 2 young kids, and I just, everything that I do at this point is to try to get to that point where, just as you said, like, I'm not going to miss a game or a recital, or whatever it is. Like, I'm going to be at all that stuff, whatever they want to do. Dad's going to be there watching. So
right.
Kind of,
well, and even for myself, I look at it too. Like, next month I'm going to a conference, and it was kind of a nice feeling that I could just take a week off. Where I remember even just 2 years ago, like, oh gosh, I got to put in a request for my boss. I got to block it off my calendar. I got to take care of all this stuff. I got to let my coworkers know that I'm gone. Just yada yada yada. It's like, oh, I don't need to get permission from anyone.
Right. You're like, I'm going to check with the boss. Oh, that's me. Yes.
Yeah,
I'm going
I'll
to
look
this
in the mirror and
conference.
see if I get myself the day off.
Right. Exactly. Yeah, it is a very, very nice feeling to get to that point, I'm sure. I look forward to that someday. All right. So second question is, can you tell me something about yourself that maybe isn't common knowledge? A special skill, a hobby, anything that might be interesting to the listeners to get to peek behind the curtain a little bit.
Sure. Well, probably about the one interesting fact I can give. There's actually only 3 Rickgarns in the entire world, so it's a very small family tree, if you'll say.
Wow, that's cool. Yeah, that's nice. That it's definitely. I'm not sure that I obviously haven't heard that name before, but it's not a common one, certainly.
Right. Yeah. If you Google it, you're not going to find very many Rickgarns. So
Perfect. I'm pretty sure all of the Balaras in the world are also just in my family. I think
gotcha.
It's a very, very uncommon last name, so we have that in common. How can people reach out to you? So if when they hear this and they want to connect, what's the best way to get a hold of you? We'll put whatever you want in the show notes.
Oh, sure. Yeah. So like I mentioned, I'm not very hard to find. I'm pretty active on LinkedIn. You can just find my name, John Rickgarn. I also run my own blog and website that has links to my YouTube channel, Twitter, Instagram. That can be at just wealthandfreedomnexus.com. Or if your listeners are driving and that's too much of a mouthful, you can just type in rickgarn.com and that will redirect you to my page as well.
Okay, awesome. Great. Final question, John, is what piece of advice would you give to someone who's maybe a few years back getting started in their investing journey? What would you tell them to help inspire them to kind of get to where you're at?
Sure. I would always say, and I still find myself in this, trough every once in a while, is don't compare yourself to others. Just compare yourself to your previous self. So if you're looking at getting started and oh, gee, Jason over here, he's got, 200 properties or whatever the case may be. I'll never be able to catch up to him. Don't compare yourself to anyone else. Just start small. It's like, okay, I don't have any real estate right now. What can I start with? And start with one property and then to two and three. And don't compare yourself to others. It's really only matters to you. Just make sure that you're constantly improving, and you should only be in comparison of yourself to your former self, really.
Yeah. Yeah, that's great. I've actually, that theme has come up a lot lately. You're only in a competition with yourself.
Yep,
Right?
exactly.
It doesn't matter what, and it's like, to be honest, you probably don't, most of the time, don't know what you're comparing. Most of the time people are comparing themselves to someone's Instagram page or someone's
Yeah, exactly.
LinkedIn profile. You're not actually comparing yourself to them. You're comparing yourself to what gets put out there. And so,
Right.
things like,
That could be misleading. Like,
exactly.
oh, I want to be this guy that bought a new Lamborghini. It's like, how do you know he just didn't rent that Lamborghini for him a day, took a
Right.
couple pictures, and say he owns it, and therefore
Right.
he's very successful.
He walked past a Lamborghini and stood in front, and someone took a picture of him. I mean, it's just, that stuff is very common in social media, and social media can be a great tool, but also it's I think it sets people up for comparing themselves to others.
Yeah,
And so
exactly.
it's hard to step back from that at sometimes. And it's, even in real estate, people talk about how many units they have. That's a common way of, like, I don't know, measuring success, but it's also what you don't know when people say that is, well, what percentage of those units, right?
Yeah.
Like, do they have 1% of 500 units, or do they have 100% of 500 units? Because that's a very big
Exactly.
difference. Or even 100% of 10 units might be better, like a higher net worth than a small percentage of 500 units. So
Right.
and
Or
again,
I put in $500 on a syndication. That
right.
syndication is invested in 10,000 units. Well, it doesn't exactly mean that I own 100% of those 10,000 units.
Right. And at the end of the day, no matter what the answer to that percentage, it still doesn't matter, right? As you said, you're not trying to compare yourself. You shouldn't compare yourself to anyone else. We talked at the beginning about, your own investing philosophy. So
Yeah.
You comparing yourself to that, if we try to compare ourselves to Grant Cardone, it's you can't get there. It's like, yeah. And anyways, like, you see that, I'm never going to be Tom Brady. I'm never, you know what I mean? It's just those things aren't going to happen, and it shouldn't matter. I just need to, sort of be better within my own stuff,
Exactly.
every day. So, I mean, really great, John. Thank you for all of the wisdom that you shared today. Thank you for your time. I've enjoyed this conversation a lot.
Yeah, me as well. Thanks a lot, Jason. Appreciate it.
Yeah, no problem. All right. Well, with that, we'll go ahead and sign out. Have a great day, everyone.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.